There are two components of trading that are critical if you want to become a successful trader. Without mastering and combining these two components, you're never going to be able to become a successful trader. The first one is the emotional and psychological part of trading. Being able to have rules in your trading, being able to bounce back after a red day, controlling your impulses. And the other one is the technical side of trading, where price action is king. And those are the magic words for this video. Price action. So let's dive into exactly what it is. Reading price action is the study of how price moves. And you can think of it like this. If we can determine how price moved in the past and how it's moving right now, we can determine what price may do in the future. And price action is completely governed by the laws of supply and demand, the sellers versus the buyers. If there's way more aggressive buyers than sellers, then there's way more demand and price is going to rise. If there's way more aggressive sellers than buyers, then there's way more supply and price is going to drop. That's obvious, but reading the relationship between supply and demand, between the sellers and the buyers, is the most difficult part about reading price action. You can think of it like this. Let's say we have 10 apples and we have 100 people trying to purchase those 10 apples. We have tons of demand for a limited supply of apples, so the price of those apples are going to go up because of the excessive demand that exists in the market. Similarly, let's say we have 10 apples, but only 5 buyers. We have way more supply than demand. We don't have that need to purchase those apples in the market. As a result, the apples are most likely going to decrease in price. And that's exactly how the market moves. There's a finite amount of shares and finite amount of cryptocurrency coins for every single crypto. So when there's tons of demand flooding the markets, people wanting to buy that stock or that cryptocurrency, the price of that cryptocurrency is going to increase. The same way applies for the other way around. If there's no one willing to buy that cryptocurrency and there's tons of people willing to sell it, then the price of that asset, cryptocurrency or stock, is going to decrease. So just remember, when you think of price action, just think of the simple definition of supply versus demand. So how are we going to make money from reading price action? So let's say you've conducted your price action analysis and you've determined that this asset, this stock or crypto, is going to continue higher in price. So you have that bullish bias on that asset. Most people, when they look at this, they just enter in randomly. They just buy that asset and they rely on hope that it continues higher in their direction. You don't want to do that, because remember, random actions and random entries will lead to random results. And random results will lead to blown accounts and you losing money in the markets. You don't want to do that. Before you enter into a trade, you need to have an identifiable trading setup and trading pattern. And with a trading setup, and we're going to be talking about that later in the video, and I'll show you which trading setups you should focus on. But with a trading setup, we're going to have a predetermined entry point, a predetermined stop loss point, and a predetermined target. And that will provide structure in our trading. We'll be able to actually calculate the reward versus risk when we know what the entry price is, we know what our stop loss price is, and we know what the target price is. So remember, you never want to enter in randomly. You always want an identifiable trading setup or pattern. Another key point is that there are several criteria and qualities that are identifiable when you are looking at trading setups. And I'm going to teach you all of them, do not worry. But when you do have those predetermined setups that you only have in your trading plan, you'll be able to actually, find the setups that are the highest quality based on what I'm going to teach you in this bootcamp. Before we talk about trading setups and the trading setups that I'm going to show you in this video, I want to talk about a very important concept, which is called price correction. Whenever we have a huge move to the upside or a huge move to the downside in the markets, we need to have some sort of price correction. Price needs to adjust before it continues higher or before it continues lower. And these price corrections create amazing opportunities for us to hop into the trade and then ride the move higher or ride the move lower. And there are two different types of price corrections that we need to know. The first one is a correction through price itself in the form of a pullback. So let's say you have a huge rally higher and price begins to pull back. That is one way the asset can correct itself, and we can actually go ahead and develop a strategy to buy that retracement in efforts to capitalize on the move higher. And whenever we buy that retracement, a lot of people think of it as buying the dip. That is called a buy setup, okay? So when we buy the retracement, that's a buy setup. The next way that we could correct in the markets is through time. So after we get a huge rally, we could actually consolidate at the highs of that rally. And for us, the strategy for that is a base breakout, okay? So we correct through time, through a consolidation at the highs, and once price breaks out of that consolidation, we can look to actually enter it. That is called a base breakout. Now, this applies the exact same way for the downside. Let's say you have a huge drop lower and we get that retracement where we move up a little bit, and that provides us an opportunity to get in for the next move lower. That is called a sell setup. So when you short the retracement after a move lower, that is a sell setup. And we could also correct through time as well. After a move lower, we begin to consolidate through time, through price, staying in that lower price area of the drop. And once it's ready to continue lower and break down, we can hop in on the breakdown and capitalize on the move lower. That is called a base breakdown. These are fundamental strategies that I trade almost every single day. And most of all of the other strategies and all of the other patterns that you see are derived from these two setups. So in summary, price correction needs to occur after we get a move to the upside or move to the downside. And there are two ways that we can achieve this correction. It's either through time in the form of a consolidation, or it's through price in the form of a pullback. And this applies both for bullish patterns and bearish patterns. And these will create amazing opportunities for us to actually get into that trend and ride the move higher or ride the move lower. So now let's quickly talk about when we are going to be looking for these setups. And for all bullish setups, right, the base breakout or the buy setup, we're going to be looking to play them during uptrends. And an uptrend is when you have higher highs and higher lows. And this is a bullish pattern. It's a bullish bias. So we want to be buying when we are actually uptrending. And we want to be playing sell setups or base breakdowns short during downtrends. That is when you have lower lows and lower highs. So we want to be playing long when we're in an uptrend, and we want to be playing short when we are in a downtrend. That sounds so obvious, but there are so many traders who actually buy in downtrends and short in uptrends. Typically, guys, 95% of the time, you want to be playing in the direction of the trend itself. And the other trend is a sideways trend. That is when you have equal highs, equal lows. You're not really going anywhere. It's not trending in any direction. It's sort of just going up and down, up and down. And typically, especially as a beginner, you want to avoid trading in sideways markets because we don't have a clear direction. You only want to be trading when we have a clear direction in price, either with an uptrend or with a downtrend. So I'm sure you're already wondering, how do we read price action? What do we actually look at? And the first thing that you're going to look at are candlestick charts. And don't worry, we're going to check that out in just a second. The next thing you could use are indicators. You could use level 2 data. You could use time and sales data. You could use market depth. And don't worry if you don't know how to use those tools. I'm going to make separate videos addressing how you could actually use these components when you are reading price action. So if you want to stick around and watch those videos, make sure you click the subscribe button below. So let's hop into a quick little brief introduction to candlestick charts. So first thing I did, I went to tradingview.com. This is a great platform for charting and reading candlestick charts for different securities. And you want to go to super charts right here. By the way, it's completely free to join TradingView. So if you're not using it already, just sign up for free and you'll be able to be looking at all the charts that I'm looking at as well. And this is what your basic candlestick chart is going to look like. You're going to see these rectangles. And for me, I have a couple of moving averages, which are two indicators that I use. Okay. And when you're configuring your charts First and foremost, you're going to want to go to this icon right here, and you want to make sure you have candles selected. You don't want to be using bars or Heikin-Ashi or hollow candles. You want to be using the regular Japanese candles. And you'll also see this little icon for indicators. There are thousands of different indicators that you could use, and you really want to, avoid falling into that hole of using hundreds of different indicators on your charts, having your charts just clustered with different lines and different, different tools telling you different things. You really want to avoid that. You want to try to keep your trading as simple as possible, because believe me, there's no magical indicator that's going to tell you where price is going to go. So you just ignore this entire list. Just make sure you keep your trading as simple as possible. For me personally, I use 2 simple moving averages. And what a moving average is, it is the average price of that security in X amount of days. So for example, right here, this is the 20-day moving average. So that is the average price of this security in the last 20 days represented as a line. This one is the 200-day moving average. This is the average price of the last 200 days represented as a line. So these moving averages, what they show me is they ultimately show me price action. They show me averages of price, and they're incredibly useful. And what I love about them is that they're simple, right? They're simple moving averages. They're, I want to say they're simple to use, but they're not, it still takes time to become accustomed to them and to know how to use them. But, in general, they're pretty simple to use as well. They're incredibly powerful if you know how to use them. And don't worry, I'm going to be making other videos showing you how to be using these moving averages in this boot camp. So make sure you subscribe if you want to watch those videos. But yeah, so I have these candlesticks. I have a couple of moving averages, and that's really it. I keep my trading as simple as possible. I'll explain all of these other tools and everything else up here in a different video. But the one thing I wanted to quickly address are these candlesticks, right? These red and green candlesticks. And honestly, they're just kind of rectangles, right? So number one, they could either be red or they can either be green. And this body, right, you could see this rectangle. The highs and lows of that rectangle are going to represent the opening price and the closing price during that candlestick's time frame. And whether they represent the opening price or the closing price depends on the color of the candle. So if the color of the candle is green, we know that price went up. If the color of the candle is red, we know that price went down. So in this case, we have this green rectangle. The bottom of the rectangle, the absolute lows of that rectangle, the bottom, and this is called a body, by the way. So whenever I refer to body, I'm talking about this rectangle. The lows of the body, that represents the opening price during that candlestick's time frame. The closing price, right, the top of that body is going to represent the closing price. So price opened here and closed at the top of the body during that candlestick's time frame. If it's a red bar, it's the opposite. That means it opened at the highs of the body and it closed at the lows of the body, right? And that represents that price went down. Now, that's the body of the candlestick, and there's another part of the candlestick that is called the tail of the candlestick. And the tail is this line right here. A lot of people also call them wicks. And the lows of the tail, right? So the low of the tail is right around here. The lows of this tail represent the absolute lows of price during that candlestick's time frame, and the highs of the tail represent the absolute highs of price during that candlestick's time frame. So, for example, for this candlestick right here, we opened at this price, right? The bottom of the body, it's a green candle, so we opened at the bottom of the body. We opened here. We dropped all the way down here, right? Because that's the lows of the tail. So we opened here, we dropped, then we moved all the way over here, up here. That is the highs of the tail. And then we dropped a little bit from there to close at the high of the body. And the same thing applies to the red bar. So you could see that The body represents the opening price and the closing price. The tails represent the absolute highs of price and the absolute lows of price during that candlesticks time frame. If that is confusing, no worries. This is just a brief introduction. We're going to go way more in depth on another video. And as you can see, these candlesticks, they form different patterns when they're in sequences. And based on the sequence and how that sequence formed, they can create strategies, right? So we talked about a buy setup or that, retracement pattern. This is a great example right here of a buy setup. We're in an uptrend, we move up, we retrace, right? We correct through price, through this move lower, and this is a buy setup, and from there we continue higher. And that's just an example. We're going to go way more in depth in the future, but hopefully that helps, and hopefully you guys understand way more about price action and how price action works. And if you want to continue participating in this boot camp, make sure you click the subscribe button. And if you have any questions for me regarding these classes or anything that you want to see in my videos, make sure you leave a comment and I will read them. And have a great day, guys, and looking forward to seeing you in the next video.